Guys, we've had two really big events happen today. The first is, of course, the executive order creating a crypto committee. And the second, which we're going to talk about first, is the repeal of SAB 121. Now, the repeal of SAB 121 was thought to be an executive order, but it was actually done within the SEC itself after the departure of Gary Gensler and after Mark Yoida was uplifted to the position of temporary SEC chairman. Now, SAB 121's cancellation is very, very important because it discouraged financial firms from holding crypto by requiring them to record digital assets as liabilities on their balance sheet, which obviously is not good for their accounting. So, the Securities and Exchange Commission has canceled a controversial rule that asks financial firms holding crypto to record them as liabilities on their balance sheet. A new staff accounting bulletin on January 23rd said it rescinds the interpretive guidance of SAB 121, an agency rule published in March 2022. Remember, this particular SAB was actually voted by Congress, but then President Joe Biden kind of overrode it. But now, since he's gone and Gary Gensler is gone, Hester Pierce is leading this crypto committee within the SEC, and they finally repealed it. So, this is a huge burden off financial firms that want to hold crypto on their balance sheets. So, like holding reserves against assets held in custody is not standard financial services practice. I think this was basically in there to discourage people from holding crypto. Other opponents, such as Representative Willie Nickel, claimed it would prevent American banks from being able to custody crypto exchange traded projects at scale, potentially creating a concentration risk by handling more control over the non bank entities. Cynthia Loomis added that SAB 121 was disastrous for the banking industry and only stunted American innovation and advancement of digital assets, and they are thrilled to get it appealed. Obviously, Michael Saylor said, like, SAB 121 has been rescinded, allowing banks to custody Bitcoin, which is a big deal. Now, on the same day, we actually have this real estate firm called Fathom joining the Bitcoin market. I'm not really sure if this has anything to do with SAB 121 being repealed or not, but they're saying they're going to have 10% of their access cash buying Bitcoins. They're only starting with 5 Bitcoins to start, but going from this pace on forward, they're going to have more and more Bitcoin. Also, the state of Kansas said it would allocate as much as 10% of retirement funds to Bitcoin ETFs. That's a whole lot. I mean, each state does have billions of dollars. And yes, while that might only be hundreds of millions of dollars or perhaps single-digit billions of dollars per year, that's still a lot of money coming into Bitcoin. 10% is actually much, much higher than what I thought these states would allocate. I thought these states would be like 1%, 2%, at most 5%. But 10%, that's a huge amount for these states to actually allocate to Bitcoin. Now, the second thing we needed to talk about was the executive order creating a crypto subcommittee. Some people actually mistake this to having a Bitcoin reserve, but that's not true. This is just a committee that will talk about certain topics like the Bitcoin reserve. That's why there was a lackluster kind of like response to this. We actually thought the crypto market would actually pump a lot due to this, but it actually didn't, because I think people wanted to really see that executive order for the Bitcoin reserve. They said they might want to create a basket of Bitcoin of cryptos, or they just might do a Bitcoin reserve. This executive order also banned CBDCs, and that ban will probably stay in place as long as Trump is in office. So if you wanted to bridge CBDCs, not happening because the U.S. is not making a CBDC. That was pretty much like according to plan, because many of the states have already banned CBDCs. So that's the major news for today. Like and subscribe, hit that bell notifications button, and I will see you guys later.